Welcome back to the show, everybody. Woo-hoo-hoo! This market is changing. We are like in a completely different environment than we were in 90 days ago, which is crazy when you think about it. I just turned 39, so I've been in the mortgage business for a little over 16 years. And so I've been around a while. But during that time, the market has been kind of in just a similar pattern of cycles. And now we're in this market where we're seeing things in the economy that we haven't seen for 40 years. So it's pretty crazy. We're in not unprecedented times, but kind of unprecedented for like people of our generation, mortgage professionals of my age, of my tenure. And so I want to talk to you a little bit about that today, and let's think about this through the lens of a consumer and through the lens of a loan officer, and how we navigate this and what we can expect going forward. So, a few of the things that have really changed and that are different in this market cycle versus others. One is inflation. So we've got inflation that's the highest it's been since the early 80s. And inflation for my entire adult life has basically been stagnant. Like it's been, as high as into the low threes, but we've never really had sustained inflation beyond that. The Fed, for over a decade, their mantra has been getting the economy to 2% inflation. And that's always been their target. And so, inflation, like right now, it's all negative in the media about inflation. Oh, inflation's bad. The cost of everything's going up. And yeah, high inflation in some areas can be bad, but in other areas it's good. Moderate inflation is good because it signals a growing and healthy economy. So what we're seeing right now, some of the highest buckets for inflation: housing, cars, and specifically the used car market, oil and gas have been very high. But those primarily make up most of the inflation that we've seen. Food, that is very volatile. So we've at times seen inflation with food high, at times, other times it's not. But one of the things that's been good with inflation is we've seen wages go up. So it's called wage-based inflation. So the cost of goods is going up, but people are making more money as well. And a lot of people have quit their jobs and gotten new jobs at a higher rate of pay this year. I had someone on my team who quit earlier this year and was able to get a higher rate of pay that I couldn't compete with. And, so that kind of thing has been happening all over the economy. So those are good things because people are scaling up their career and earning more money. But with the inflation that we've seen, that's been a very different cycle because we haven't had this for 40 years. So that's one of the things that's been very different with the cycle that we're in right now. With the inflation that we've seen, mortgage rates are most closely tied to inflation. So, when we look at mortgage rates and how they're determined, basically, to just simplify it, when a mortgage is closed, it gets sold to one of several different government agencies, and then they package those loans and sell them to Wall Street. And then on Wall Street, they get traded as long-term bonds, and they're called mortgage-backed securities. And so because mortgages turn into long-term bonds, mortgages are most influenced by inflation. Because when you're investing in a bond, what happens is you pay a fixed amount of money up front for a guaranteed return over a specified period of time. So if the value of a dollar is going down, which is what happens when we have higher inflation, then you're going to want to earn more in interest income on that bond to compensate for the value of the dollar going down over that period of time. So the rate of interest that's got to be paid on that bond has to be higher. And so that's why we see interest rates on long-term securities like mortgages increase when we have high inflation. And so that's what we've been experiencing here. And a lot of the inflation that we've got, it can be tied back to some significant government spending over the last 3 years with COVID. And and I don't want to get like too much into politics here with this whole thing, but we were passing out checks to people during COVID, almost just carte blanche with hardly any verification. People were getting a ton of money from the government. And when that much money is pumped into the economy, it's going to cause inflation. And so now we're starting to feel the effects of that at where we're at today. So we've got this high inflation. We've got home prices that rose dramatically during COVID. During COVID, we already didn't have enough homes for sale because builders were not able to get the labor that they need to build homes. And then COVID hit. And then now all of a sudden, not only did they not have enough labor, they didn't have enough materials because supply chains were cut down during COVID. And then builders have trouble with reparceling land and getting land that is such that they're able to build affordable housing on it. And so because it's difficult from a bureaucratic and municipality perspective to reparcel land and make lower cost housing, that's also driving up the cost of housing because builders, they're not able to turn a profit on low cost housing. So they have to build more expensive housing. So these things have all been working together here to drive up home prices and to drive up interest rates. So, the inflation that we've seen this year is the highest since it has been the highest we've seen since the early 80s. And mortgage rates in the early 80s got up into the mid-teens, 14, 15% on a mortgage. And so now what we've seen here this year is the combination, I call it like the two-headed monster, the combination of high interest rates and home prices that have risen significantly over the last 2 years. Now housing has become less affordable, and so much so that it's really pulled back buyers in the market, and buyer activity has slowed down dramatically. So like if we look, every market in real estate is a little bit different. So the adage is always that real estate is local. So there's not like a national real estate market because all the different markets and states and cities and metro areas, they all have their own dynamics that that will affect what happens in those markets. But if we look at the Phoenix market specifically, in the spring, March, and as late as April, we had around 4,000 active listings, active homes for sale in Maricopa County. To be at a balanced market in Maricopa County, we need to be around 17,500 homes for sale. So significantly under supply in Maricopa County. And just simple supply and demand. If there's very little supply and there's high demand, then we see the price of goods go up. So in this case, it's happening in real estate, not nearly enough homes for sale, lots of buyers out in the marketplace because rates are low. And so what was happening? Prices were going up. Well, once we hit that point where affordability went way down with higher rates and higher prices, that slowed down the demand because buyers finally got to this point where they're like, okay, between a 6% interest rate and a home that has gone up to $150,000 in value, I'm going to wait and I'm just going to see what happens. So then as buyers started pulling back, sellers started realizing that the market was cooling. And now a lot of people have been listing their home for sale, trying to capture the prices that are here today. So now we've got this opposite effect where buyers are pulling back, sellers are stepping forward, and inventory has built up in a hurry. So from the end of April to the end of June, we saw active listings go from about 4,000 in Maricopa County up to 16,000 active listings in Maricopa County. And now, today we're over 16,000 active listings in Maricopa County. I'm recording this right now in mid-July. So with the trajectory that we're on, we are on pace to be to a balanced market in the next 30 to 60 days. And if this pace continues, we'll actually be into a buyer's market in the next 60 to 90 days. And so in a buyer's market, we could see home values come down. Doesn't always happen, but it's not, home prices will not be going up at the rate that they were going up earlier this year. So like the last couple of years in the Phoenix metro area, home prices have been going up between 20 to 30% year over year. Now we're going to see that number slow down significantly. And actually right now we're seeing tons of price reductions. So what's happening is people are still listing their home at the top dollar price, hoping that they can get top dollar for it. And a few of those are selling, the ones that are like check every single box. They've been remodeled, have a great lot, have an amazing backyard. They're really well taken care of. Those homes are still selling pretty quick. But anything else that's not like the perfect dream home, those homes are not selling for that top dollar price anymore. So sellers are having to reduce their price. And, like I've got a Zillow account where I'll get on and look at homes for sale in Zillow. My Gmail is like flooded with those email notifications that say price reduction on such and such home, price reduction on such and such home. And so we're seeing tons of price reductions. So home values per se are not going down yet, but active listing prices are going down significantly. Okay, so if we, it's hard to say how this is going to play out for the second half of the year, but I would be surprised if when we look at the total numbers for 2022, if home values in Phoenix went down as like an aggregate total for the year's activity. But I would not be surprised to see home values for Phoenix having risen less than 10% this year, because they were rising at 25, 30% at the beginning of the year. Now they're not rising. They might even be going down a little bit. And so in 2023, who knows? It's possible if the inventory stays high and we continue to see a buildup in inventory, then it's just simple supply and demand. If there becomes an oversupply of homes and not enough buyers, then we would see prices come down later this year or in 2023. And that's what happened in 2008. In 2008, there was a humongous oversupply of homes, not enough buyers because we were in a deep recession. And that led to a huge decline in home values, 30, 40%, depending on, what market you're looking at. So going forward here, now with where things stand today, this is a phenomenal opportunity for buyers because, we can't predict what the market is going to do. We know what the market's doing right now. Listing prices are coming down. Inventory is building up very quickly. We're working our way toward a balanced market. So we know that that's happening right now. We don't know how long that's going to last. But while we're in this period here where sellers are starting to get nervous, and keep in mind, markets are all based on emotion and psychology. The stock market, real estate market, anything else. What drives these markets is what people believe is happening. And what people believe is happening is not always in tune with reality. But sellers are starting to believe that they've missed the boat and they're getting worried that they're not going to be able to sell their home. So what do? They panic and they cut the price, right? So now if you've got a seller who's panicking and cutting their price, if you're the buyer, you have negotiating leverage. So we know that right now and over these next few months, there's some really great opportunity to pick up a property with some leverage as the buyer. And when we look at recessions over the last 30 years in the U.S., the last 5 recessions that we went through here in the U.S., contrary to what a lot of people would think, housing did very well in 4 out of 5 of those last recessions. The only recession that we went through where housing did not do well was 2008, that big crash. But that was because in 2008, we crashed due to poor lending practices in the mortgage industry. There were a lot of loans given out that shouldn't have been given out. I recorded another podcast where I take a deep dive into that. So check that out if you want to know more about that. But that was essentially a mortgage crisis. Now we look at the performance of loans being originated over the last 10 years, super strong, strongest it's been in decades. And all the loans were underwritten, with really strong underwriting guidelines and standards. And trust me, I know, I do this for a living. There are a lot of cases where it's not easy to get a loan. You got to really qualify, and we verify every single detail. So the quality of loans that's out there today is really strong. So I don't expect to see a major crash in real estate. But it's certainly possible that we're going to see a pullback here in real estate in the short term. But what happens when we look at those other 4 recessions? Housing did really well because interest rates went down. When we go into a recession, the government's got to cut rates to try and spur economic growth. So right now we're in the part of the cycle where the Fed is still raising rates. We expect the Fed to raise rates again at their next meeting, 0.75%, which is 75 basis points. That's a historic rate hike because they did that in their last meeting, 0.75%. That was the biggest hike since the early 90s. So we expect them to do that again. So back-to-back rate hikes of 0.75%. When the Fed is hiking rates, that is, they're changing what's called the Fed funds rate. And the Fed funds rate is a rate that banks pay to borrow money from the Federal Reserve. So the Fed has direct control over that rate. When the Fed adjusts the Fed funds rate, that will directly impact your credit card interest rate, your home equity line of credit interest rate, car loans. Does not directly impact mortgage rates because, like I said earlier, mortgages are most closely tied to inflation. But as the Fed hikes rates, what they're doing is they're making it more expensive for businesses to operate in the economy, which slows down the economy. And then as the economy slows down, we're going to see inflation slow down. Well, what happens when inflation slows down? Mortgage rates are going to come down with it. So when we go through recessions, housing tends to do very well because interest rates typically come down. And when interest rates come down, then it's cheap money to buy a home, and that brings a lot of buyers out. So where I'm going with all of this is that we don't know how long it's going to take to play out for us to be into a recession and for the economy to start to see rates coming down, and for that to then bring the buyers back into the market, which is then going to soak up the supply. And we won't know that we've hit that point until it's already behind us. You know, when we're in it, it's hard to know if it will continue or if we've hit the bottom. And so by the time we know that we've hit that point, it's already past us. So what you should do is invest while it's going down. And this is the same thing with the stock market. Like if the stock market is going down, you want to be layering money in as the stock market is going down. It's called dollar cost averaging. So like, let's say the stock market was going down, 1% per month for 6 straight months. So now it's gone down 6% over a 6-month period. If you put in an even amount of money, say $1,000 a month for 6 consecutive months, you've now invested $6,000, but you've layered that money in over a 6-month period. So you've bought at a steeper discount each of those months. And when you average it out, you've basically bought all of that stock at an average of 3% down from what it is today. That's called dollar cost averaging. So you want to do the same thing in real estate. Don't wait until everybody knows that we've hit the bottom, because by the time that's happened, we'll be back into a seller's market. It'll be very difficult to negotiate. If you buy before we reach the bottom, then you've got that negotiating leverage and you can get a better deal while there's more homes on the market for sale. So as a buyer navigating this market, I think you should really take a look at buying a home while things are down if it's within your means, because this is the time to do it. For loan officers, right now, transaction counts are way down. And so I think a lot of loan officers will look at this and say, okay, business has slowed down. I'm going to go ahead and I'm just going to relax a little bit, and I'm not going to work quite as hard. I don't have as much business coming in. This is a good time for me to spend time with my family and just relax and almost take a little vacation. There's nothing wrong with taking a little time to breathe, but during these parts of the cycle, this is when the really good businesses are built and made. And we should be investing in our business right now. Even though our income is down and our commission is down, this is the time when over these next several months, depending on how long it takes rates to come down, we're going to see a ton of mortgage companies go out of business. Already, almost every mortgage company in the country is negative in profit for the last several months because transaction counts are so far down. So every mortgage company right now is struggling financially, and a ton of them are going to go out of business. The lenders who were doing mediocre volume over the last couple of years, they're doing almost no loans right now. So we're going to see a ton of loan officers get out of the business. And even though the pie is shrinking, your slice of the pie could grow if you lay the right seeds and plant the right seeds and lay the right foundation in this downturn. So for me, I'm investing money into my business. I think finding a way to go direct to consumer is a really smart way to go and a place that you should be. And I'm going direct to consumer by doing home buyer seminars. So we're marketing those on Facebook. We're filling a room of home buyers who are looking to purchase their first home. I'm educating them on the process. Now I've got a group of leads that I can market to. And then as I pre-approve these buyers, I've got pre-approved buyers who I can refer to a real estate agent. So now it puts me in a position of helping my real estate agents that I work with grow their business. And it also gives me a carrot to go out and get new relationships with new real estate agents. So direct to consumer, you should be investing in that. Even looking at online leads, investing in leads that you can purchase through Zillow or Facebook or any of the other online platforms that are out there. As there's a smaller number of deals to be done, there's good opportunity to do the really outside of the box deals. So non-QM business, non-qualified mortgages, those are a great opportunity to market right now. And financial advisors, small business owners, CPAs, these are people who are in contact with business owners and other people who might be in a financial situation where they could benefit from a non-QM loan. And as we're in this cycle, rates are really competitive. So there's a lot of rate shopping going on, and that makes it difficult for mortgage lenders competing on rate. Well, with a non-QM loan, those buyers are just happy to get approved for a loan, and they're not as concerned about what is my rate and does this company have 1/8% lower. They're just concerned about, can I get a loan? Can I make this happen? And if you've got non-QM products to offer, then you have some tools to give that client to get an accepted offer. And then, the last thing that loan officers should be doing is really digging in and getting face-to-face and adding value where they can for all of their referral partners. Because, as loan officers start getting out of the business here, real estate agents are going to be losing their preferred lender. And the lenders who have been in front of them, who have been calling on them, educating them, helping them with their business, they're going to be right there in a position to get that relationship when that preferred lender decides to go back to selling cell phones at Verizon or whatever they're doing. So you got to keep planting those seeds. You got to market even harder in this downturn to set yourself up for success and getting a larger share of that pie when the market starts to turn around and go back up. So that's just a few thoughts on where the market's at today. I would love to talk to you about this further. If you have any questions, shoot me a DM, shoot me an email. Love to hear from you and appreciate you joining the show.